We're talking to Dave Kelly from Fairway Mortgage. Just given the fact that we have so many different things happening in real estate today with the mortgage market, lending, that sort of thing, and given our current crisis situation we're dealing with, we're in uncharted waters. And so I was hoping to be able to get just some input from you and what's happening in the marketplace, because I know a lot of people have questions, and I know that they can always reach out to you, after this, or we'll make sure that we have all your information on here for people to be able to reach out to and make phone calls or emails. But
sounds good.
So anyway, well, good morning, David.
Good morning, Tony.
Yeah. Hey, so with this situation we're in, like I said, we're on uncharted waters. I guess the big thing here is that we've had just an influx of interest rates, where they've been up and they've been down, and I know that the question is where are they going and what's happening, and I was hoping maybe you can give us some insights to what's happening there.
Yes. A few weeks back, we were in all-time lowest rates as far as interest rate environment is concerned. And then what happened is the CARE Act got passed. And every time there's something that happens within Congress, they have good intentions, but there's always unintended consequences. So what we saw with the CARE Act, what happened with that is they're really trying hard to buy down mortgage-backed securities, okay? Because they want to lower interest rates, but they didn't understand how the whole market works. So when you're trying to buy, what the government did is they stepped in and bought mortgage-backed securities in the hope that they could drive down interest rates. But what they forgot about is the fact that every time you're a mortgage company, when you have a mortgage out there that's locked, you have to hedge that mortgage in the marketplace. So the company has to put a certain percentage, usually between 1% and 5% of that mortgage amount, and they have to put that up as cash. So when the government went in and tried to buy down the interest rates to make them even better, what ended up happening is they went the opposite direction. And because of that cash that was required, companies all of a sudden had to start writing checks. We wrote several checks, hundreds of millions of dollars in checks that went out to the warehouse lines. And so unintended consequences is it drove up the interest rates. The other thing that happened too is the government came out and they wanted to help, and they wanted to offer the forbearance plans. Well, if you're a mortgage servicer and your servicing portfolio is given the opportunity to not have to pay for their mortgage for 12 months, the servicing company still has to make those payments. That's in their contract to the investors that buy those mortgages. So the problem is it puts the servicers in a horrible position where they have to pay for those mortgages. So again, good for the consumer in that they get a break on their mortgage payments while we're going through this difficult time.
Right.
But they didn't think the whole thing through. Now there is going to be some things that are going to happen in the next 2 weeks that I think we'll see some servicing. We'll see the liquidity help. They're putting some things in place. I just watched an interview with Dave Stevens, who used to head up the MBA Mortgage Bankers Association. And so they're putting things in place, the government is. They're aware of the problem. They're going to fix it, okay? And what that will inevitably do is it will drive down mortgage rates again. So like right now,
we're looking at potential lower interest rates than we currently have.
I think we're going to see lower rates than we've ever had before.
Hypothetically. Oh, really? Okay.
I think if it was good if you took advantage of it a few weeks back.
Right.
But definitely now don't feel like you've missed out, because they're going to come back, and the government and the Fed is going to do everything they can to make mortgage rates lower as we come out of this. This is temporary. The virus, it's a virus. It's not like the recession was last time. Okay?
Right.
It's going to be a dip, and then it's going to come back.
Yeah.
And when it comes back, there's going to be pent-up demand, and the government housing is one of the hugest drivers in our economy right now.
Yeah, it's a huge aspect of our GDP.
Absolutely. So they're going to do everything they can to keep rates low. And there's already pent-up demand, and there was not enough supply. So I would say if you're sitting on the sidelines right now, this is a great time to buy, to get in.
Yeah.
And again, if you can be a little patient with the interest rates, they will come back, and we will see better rates than we have right now.
Even if someone needed to buy today, I mean, in the respect of, there's some people that they have to move, they have to relocate, whatever. It's still at this point. I mean, just with today's rates, this still is record low.
It's phenomenal. I mean, you're still in the threes on a 30-year,
right.
So it's not like that's not like it's gonna be something that you're going to, I guess what I'm doing with a lot of my clients is if we're having to do something now, and we're having to lock right now, we're just making sure when we do lock and when we do structure that mortgage, that we don't have a lot of upfront fees. So we're not paying points to buy down the rate.
Correct.
Okay, because we're going to have an opportunity to refinance it down the road. So why would you put a lot of money into this mortgage now? Yes, rates are great,
Yep.
But then down the road, we will have an opportunity to refinance. So let's save some of that money that we were going to invest in the mortgage now. Let's invest in it later on to get you the all-time lowest rate possible. Okay.
Right.
Yes, they're great. They're phenomenal right now. But I do have a feeling they're going to get even better yet.
Well, and I think the other part of the reason I have a conversation with you, and we have a number of lenders we work with, but I know that the people that, and our clients who've worked with you have said nothing but great things in reference to
Thank you.
that you work through all the different scenarios. Like, if you do this, the outcome is this, and and I think that that's what people need. The more information that people have, it allows them to make an educated decision.
Absolutely. And people call in and they ask, well, what's your rate? If somebody quotes you a rate on the phone, run away as far as you can, because there are more than 20 factors that go into determining what your interest rate is.
It's not just about
so if
rates.
I'm quoting a rate,
Yeah.
I don't know anything about you,
Yeah.
and all I'm trying to do, I hate to say this, but it's kind of a bait and switch tactic where I'm trying to lead you in with, okay, you've got the all-time lowest rate. And then they get you in the office, they talk, and they say, wait a minute, I'm sorry, that's not what the rate is for you because your credit score is X, or
Right.
you don't have 25% down, so this. So, unfortunately, if you go based on rate alone, you're probably going to get burned. And
Right.
so that's not what the most important thing is. The other questions that people need to ask is, how long am I going to be in the home? What are my goals for it? And also looking at your other financial goals too. Not just what is my rate.
Right,
So, yeah.
right. Because a lot of times when people talk to me about, putting money down and that sort of thing, as I said, talk to your lender, talk to your
Absolutely.
financial advisor, because you may have enough money to buy the house with cash, but my thing is, with the rates being what they are, maybe you don't want to do that, and maybe it'd be better to use that, use a mortgage for part of the home and take that cash and be able to utilize it for other investments.
Right. Going back to the all-time lowest rates, maybe you can invest that money somewhere else, or
Right.
pay down other obligations that you might have that have a higher interest rate.
Right.
Absolutely.
Okay. Well, I appreciate that in reference to to wrap this up in reference to where the interest rates been, where they're going. If I understood you, just said we got a little volatility with the amount of demand, and then and the people being able to service the loans to a certain degree. So that's why the rates went up for a little bit.
That is the
Now
biggest
they've
thing.
started to come back down a little bit, but you're saying that these may even be lower than what we're seeing right now, and
Absolutely.
record lows. So that's the good news, the silver lining to part of this conversation, I think.
Right. It's a liquidity issue. And so once the servicing, because in the past, the servicing release premium, every mortgage loan had a certain premium that you get on the backside of the loan.
Mm-hmm.
We saw those drop from maybe around a 2.25% range to a half a point. Okay. Now, if you're not in the mortgage industry, you probably don't know what that means. But at the end of the day, those people that service mortgages don't get as much money. And so why would they ever want to do that? Especially when you combine the risk of the fact that people are losing their jobs and won't make their payments.
Well, therein lies the where
And so
we're
it's locked up right now, but it's gonna start flowing again, and things are gonna start. And again, some of those things they're putting in place will help tremendously. And then going back to it, it's gonna get a lot better.
all right. So let's transition to related to that the issue with the whole thing without the number of people, the unemployment, the potential unemployment rates, that sort of thing. Obviously, we're taking this all day by day with the news that we get. What is it that people should consider, shortly in reference to what buyers should consider and what sellers consider, like buyers, what they should consider related to what the crisis we're going through now versus what sellers should look at, like when they do get an offer, and what is it that they have to be concerned with?
I think right now, in this current environment with all of the layoffs happening, you have to worry about the jobs of the borrower. As far as, okay, they have a job now and they're making an offer on the property, but will they have a job when the loan closes? And again, this is all temporary. This is something where a lot of people are being furloughed. The intention is for them to come back. So one of the things that we want to make sure of is the job solid. It doesn't hurt to ask what industry are they in, what are
Right.
they doing, exactly. I mean, if you're a nurse at one of the hospitals, think about that. They're going to be in demand. That's not going to be an issue. That loan is going to close.
Mm-hmm.
Hard to say. If you're in a department store setting, that may not be as solid as something like working for a hospital. And not to be biased or anything like that, but I guess the job is probably the most important thing right now.
Well, if
And
you have
how
two
long
offers
it
sitting in front of you and you have some information related to what both buyers do, that actually would factor into a little bit to the decision process. I mean, if I'm working for my client as a seller, making sure that I can try and make sure that we're working with the offer that would best suit their needs.
I think you have to do your due diligence to make sure that, it's just one of the questions that might have to be, that we haven't asked in the past.
Yeah.
Is how solid is that going to be for the next 30 to 45 days?
And we know this is a temporary arrangement, but in the same token, temporary, even though when you're sitting in isolation, so to speak, temporary seems like a long time when you're, in your house most of the day,
right,
type
exactly.
of thing. So, and on that, we can have deals that go, everything is done, everything is squared away, but we're ready to close tomorrow. And in the meantime, the underwriters make a phone call and find out that the people that were borrowing had, for whatever reason, were furloughed or laid off. That will stymie a deal, correct?
In the past, we had a 10-day window where we could verify employment before closing. So we do it at the beginning of the loan process, and then we have a window at the end where we have to double check that. That's with all mortgages. Okay?
Right.
That just got changed in the last week to where we have to verify employment the morning of closing. So it's not, and that's
right.
that again goes back to that servicing issue. Think about it, as you're buying that mortgage-backed security or you're buying that investment as the investor side, maybe the loan closed, but it could be another 30, 45 days before that loan gets delivered to the final investor. There's another window there where somebody could be potentially losing their position, and then guess what? That doesn't get bought. That doesn't get bought by the investor, so then that's a loss again too. So there's a lot of new requirements around employment and verifying that and making sure that that is something that is solid. Plus we're also seeing increases in FICO scores. You have to have a minimum FICO score to be able to qualify for the loan. You're going to see that change. We also saw a lot of loans that were probably, I wouldn't call them borderline, but more aggressive financing products.
Yep.
Those are gone. Those are off the table.
Okay.
And we did just see, it was announced, it's not public information right now, but we heard through the grapevine.
But you're making it public now.
Maybe I am. One of the largest banks out there has stopped doing VA loans.
Oh.
And FHA loans.
Wow.
So that's a big thing. Those still exist, and they will exist in the future.
It's just that it was a decision by that bank not to.
The problem is it goes back to that risk.
Yeah.
And it goes back to how do you verify things during that process.
Gotcha.
And so they're just electing not to offer those products, and it's temporary. Okay, but if you were in process,
right.
What does that mean right now?
Right.
And so there's a lot.
Do you have to get shuffled to another lender or provider that will handle it? So.
And anytime there's a shock or there's something that happens, there's times where people are trying to figure things out, and it gets a little bit choppy in that figuring out process.
Right.
But down the road, it's going to work itself out. And
Good.
Again, yeah.
Good.
Well, we don't know how long that's going to be, but again, we'll see. So your lender, I guess, what's really important is making sure that they know what they're doing, and that they're looking at all options for you. So in case one option goes away, we still have another option.
Absolutely.
Yeah.
Yeah.
I think
there
that's
you go.
Also
Whereas
something that's
if
important.
you put all your eggs in one basket, there's a good chance that it might be a problem, especially in times like these.
Or again, we're seeing debt ratios being lowered too. So that's also changing to where maybe they were okay here, but now we can't.
Right.
So again, it's just that is something that we'll see here, but I think it's going to work itself out eventually again too.
Okay. Well, I know that that's one of the things that we're working through, and we want to be as prudent as possible for all parties involved when it comes to buyers and sellers. So to that point, the other thing is we've had these really low interest rates that we experienced a couple weeks ago, and now they're starting to, and then they went up. But before that, you had a whole rash of applications for refinance.
Right.
And so, and I guess let's talk to that point, because we have a lot of clients that they're asking us, is it a good idea to refinance right now or to take a look at it? What would your response be to that?
My response to that would be to get ready. So right now for my clients, there were people that took advantage of the lower rates before, but knowing that I guess there's a very good opportunity that rates are going to be even lower than they were before, I think it's very prudent that, what was the statistic I heard? There is over $11 trillion in mortgages. And in our best year, the mortgage industry can close $2.125 trillion. So there's 11 trillion mortgages out there, probably will be able to take advantage of refinancing, but we only have the capacity for maybe 2.5 trillion.
So the ones that happen to get ready around the front end of this are the ones that will be able to take advantage of these lower rates, because it's not like the window for this. We don't know what the window is for the lower rates if and when they show up.
It will happen fast, and we don't know how long. It should progress out a few months at least, but again, I'm getting all of my clients ready. So we're doing the paperwork.
Yeah.
We're getting the appraisal process out of the way, and then we can wait and we can watch. Again, it depends upon the situation. Some people can have an immediate benefit by taking advantage of things right now.
Right.
And there is always the risk that maybe things don't happen as some forecasters are saying. Okay, I am not an expert in that. I listen to other people that are experts in that.
Right.
But nothing's ever 100% guaranteed. So if it can make sense now, maybe it does make sense now. But for those people that, let's be honest, in our history, in our careers, I mean, the rates that we've had, anything under a 5% is a phenomenal rate, in my opinion.
Right.
I mean, I think the average rate over the last 30 years, or the average is somewhere closer to 6%. So where we're at right now and where everybody has for mortgage rates is really, really good.
Again, today's rate is phenomenal.
So it is important to it's just like in the stock market, it is important to get the bottom.
Right.
The all-time bottom, no. You hope to get close, but you don't want to, because
Right.
you could miss it too.
Yep.
So I'm just advising my clients to get ready for that, because we also have to have capacity for purchases too, don't forget. And so we don't want to put all of our eggs in that basket of refinancing. We want to
Sure.
make sure we have capacity for purchases as well
Yeah.
too.
Well, I know that you and your team and your company are just as busy as ever trying to keep up with, trying to balance that between refis and new purchases.
All of our purchases have a priority track. We're still 24 hours underwriting with purchases. Our company has always been that way.
So that you're talking about the purchases get priority over refinance.
Oh, absolutely.
Which is great for people to know that that's the case.
Yeah, absolutely. Well, I mean, because a refinance can be moved anytime. Does it matter if you close on a Tuesday or a Friday on a refinance?
Right, because we're not having to move out of a house and move into a new one.
But does it matter if I can't move in on a Friday versus a Monday on a purchase? It's huge.
Well, there's a domino effect that happens because a lot of offers are contingent upon everybody's waiting for one house to close so the next one can close, and when that first one doesn't close, now all of a sudden everybody else is all jammed up.
Absolutely. And our business has been built on purchase business, so that's what we are good at. And so that's where we don't want to lose that advantage that we have in that process.
Okay. All right. Very good. Well, so what you're telling me is I need to get my application in to get myself ready for refinance, if that's the case.
Absolutely.
All right. So noted. Thank you. Appreciate that. And I know that you guys provide a lot of other products, with Fairway Mortgage, and we've kind of touched recently on the whole subject of doing reverse mortgages, and I know that there's a lot of questions, and I think we could probably do an hour-long segment related to reverse mortgages.
Very easy.
For people who have homes, they have this huge asset, but they would like to tap into that asset so that way they could use those funds to do things like maybe buy a second home, or help family members out, or in a time of need. Especially with times like today, where all of a sudden there may be a need to be able to utilize some of those assets.
Absolutely.
And so I don't know if there's a short version to this, but if you have one, I would entertain, related to reverse mortgages. What would you have to say to people about reverse mortgages?
Our philosophy here is that you have to be 62 years old. One of the borrowers has to be 62 to have a reverse mortgage. So our goal here is education. So we have a reverse mortgage specialist. And so whenever somebody that's over age 62 comes to us, we make sure they're aware of that option. We're not here to sell you on one option or the other, but we're more about education.
Right.
And that product has improved immeasurably over the last few years. In retirement, none of us know how long we're going to live. So how do you prepare yourself for something? You don't know if your money's going to run out. We've done reverse mortgage loans for people that are 101 years old, okay? You don't know how long you're going to live.
Right.
And so you have to make sure that when you're headed into retirement, you are set up for the best possibility of success possible. And that truly, in my opinion, is also leveraging a reverse mortgage.
Sure.
Because who in their retirement years needs to be making a mortgage payment, right? You shouldn't be. And because if you're going to be making a mortgage payment, you're going to be drawing down on your assets that you have, maybe your IRA or your 401k. You're going to be drawing that down to make that mortgage payment. Well, that makes no sense at all. Keep that money liquid so that it can keep working for you and you can invest that money,
right,
and let your house make the payment. Why do we have in this industry or in this world that, I always have to have a free and clear house? So maybe I've got a free and clear house over here, but I've spent down my entire retirement savings over here.
Right.
At the end of the day, that can't go to the grocery store. You can't go to, to buy things or to go on trips, whatever that you need as you go through retirement.
Well, I think the other thing is that people think, well, I can only do that if I completely own my house outright, and that's not necessarily the case. I mean, you could have a $300,000 home or whatever, the value of the home, and you still owe, $100,000 on that home, but you could still do a reverse mortgage based on the equity of that 200,000.
Absolutely.
And I think that's the message that sometimes people need to know, that how do they make their asset potentially liquid if they want to?
Well, two things I want to touch on. One is the ability that I was not aware of before I started studying the product, but you can set up a reverse mortgage line of credit and not advance anything on it. Okay, so you can set up, it's just like a HELOC. Okay,
Yeah.
so if I have a free and clear house, I can have a HELOC, and my loan to value is based on my age. So the older I am, the bigger my reverse HELOC I can set up. Okay,
Right.
that line of credit grows by your interest rate every year. So your available line of credit, so let's say you have a $100,000 line of credit, and let's say you have a 5% interest rate. The next year, your line of credit available line is $105,000.
Right.
So it's kind of a reverse thing. You actually want a higher rate in a reverse mortgage because your available line of credit can grow. Now, you only ever owe what you owe on your house. So if you've never advanced anything on that, then that's fine. Your heirs, you pass away, they get all the equity in that house.
Right.
However, if things are difficult, things
You
are
pull
challenging,
$50,000 out hypothetically of that 100,000.
you can do that anytime. You don't have to go to a bank to find that out. So
Right.
if something comes out, you need a furnace fixed on your house, something like that, you can advance on that line of credit and you don't have a payment against it.
What a great
So-
peace of mind for people to have if they, because I think that's one of the major concerns that people have is,
What do I do in retirement? And when I need access to my equity in my house,
right,
I don't want to get a regular home equity line of credit because that has a payment on it. And let's not forget, last time in the recession that we had in 2008, the Great Recession, banks were calling their HELOCs due. Okay, you don't want to be in that position when you're in retirement.
no,
A home equity line of credit with a reverse is set up until you're age 150. Nobody can call that loan due. As long as you pay your taxes and your insurance, nobody can tell you that you have to move out of it.
so when I turn 150, then I have to pay that back.
Then you would have to pay that back.
All right, well, I
Okay.
guess I'll have to plan for that. My balloon payment that I have to make when I turn 150 years old.
And a lot of people aren't aware of that there's something called a reverse purchase mortgage. So again, that in my opinion
Yeah.
is one of the greatest tools. It came out about 4 years ago, and I love that product because it's like, for anybody over age 62, yes, I can get a mortgage. I can also do a reverse purchase mortgage, and I can
Right.
still make payments on that reverse purchase mortgage. So again, let's say I'm buying a $200,000 house and I have a reverse mortgage for $100,000. Okay,
Yep, yep.
you can make payments on that $100,000 mortgage, and the rates aren't that bad right now. So you can make payments on it, but the benefit it gives you is maybe something happens in the future where you can't afford to make those payments anymore.
Right.
Stop making the payment if a reverse mortgage. Nobody
Yeah.
cares.
Yeah.
As long as you pay your tax insurance, you're fine. Okay? Over here, if you had a regular mortgage, you still have to make that payment or you're going to get foreclosed upon. So again, the thought is it just gives you more options in retirement
Yeah.
versus, and so we've got to get out of that mindset that I've got to have a free and clear paid house, and then we got to look at all of our assets equally, not just our house as being free and clear. That has to be on the same level footing as our other assets, like our IRAs. And we look at all of them together and what is the best way so that we can be successful with our retirement. And so that's what the reverse mortgage gives you. I will be doing it when I'm age 62. I am firmly convinced of it. If it's still available at that time, it's definitely a tool to help you in retirement.
And you have credentials in reference to the lending that you've been accredited to. You were telling me about that, and I was just curious in reference to your
My
credentials.
wife tells me that, she says that you should have been a college professor. So what I like to do is I like to take education courses. So certified reverse mortgage planner, certified mortgage planner, certified divorce lending specialist, and a certified military lending specialist. So whatever designations you can get out there, I go for that and I learn about it and I get that. Because
That's
again, I want to
wonderful.
offer education to my clients.
Yeah, no, and that's where I'll circle back to when we started this, is that I know that my clients that I've sent to you and have always considered you a wonderful resource to answer the questions. And sometimes it's not even about doing something, sometimes it's just about getting an answer to some of their questions. So that way, if they decide to act, they can.
Right, absolutely. It's about education, about
Right.
knowing. Because you go through a mortgage process maybe every 7 to 10 years. You need somebody to help you with that process.
Right,
So, yeah.
right. Well, Dave, thank you so much for taking the time today to talk about this. We're hoping to be able to put some of this out on our YouTube channel, and we'll have some of the links about how to be able to contact you and your team, and some website links, that sort of thing. So,
Absolutely. Always a pleasure working with you, Tony.
yeah, you also. Thank you,
All
Dave.
right.
All right.
Air fist bump.
Yeah, boom. Yeah, thank you.